Hey there, welcome to Tallied. I'm Kiran and this is my first video on this channel. Our first topic under cost accounting is going to be process costing. So let's get started. Process costing. The topics for this chapter will be broken down into 6 videos. Introduction and theory, process account, all accounts, FIFO method, weighted average method, and unique questions. Today, we are going to do the introduction, theory, and key elements of process costing. I request you to watch this video before going ahead with the problems to better understand the concepts. The agenda for this video: what is process costing and what are we accounting for in process costing, and elements under process costing and their explanation. You'll find the timestamp in the description below to help navigate yourself. This is Jake, a college fresher. Jake wishes to buy a shirt and decides to shop. But Jake starts to wonder, what can be the process of making this shirt? Process 1 can be sewing and stitching the cloth. Process 2 can be dyeing the shirts in desired colors, and the last process can be fitting buttons and tags. In process costing, we account for expenses and income incurred during various processes of making a product. It helps determine the cost at each stage. The costs incurred during production are charged to the processes and averaged over the total number of units produced to determine the cost of the product and account for various other values.
Now we'll talk about the different elements in process costing. Normal loss. Let's take the previous example. While making a shirt, some extra cloth goes to waste while cutting. Some buttons purchased can be of the wrong size. This can be considered as normal loss. In other products, normal loss will be lost ink while manufacturing pens, fruits and vegetables rotting over a period of time, etc. Most of the time, units of normal loss can be sold at a lower value. In our own example, extra cloth bits might be a wastage for making shirts, but can be used for making pouches, crunchies, bags, etc. So we can sell these cloth bits at lower values like 2 rupees per meter. This is called normal loss realization. Generally, it is assumed that no work has been performed on the normal loss. There are two things that differentiate normal and abnormal loss, and they go hand in hand. The first being nature of loss. Normal loss is a part of the business cycle, so it happens on a regular basis. Like we discussed before, extra cloth, spilled ink, evaporation, rotting of fruits and vegetables, etc. On the other hand, abnormal loss is due to abnormal causes like loss due to theft or loss due to fire. They do not happen regularly and are not part of the business cycle. Before we go on to the second differentiation, let's understand what is abnormal gain, also called abnormal effective, and see how it takes place. So you might think abnormal loss is due to theft or fire. Now, how is it that I'm going to get an extra apple or an abnormal gain? Pay close attention to this. Let's say you are an apple farmer and it takes 2 days for your apples to get to the city. Now, in these 2 days, during the transportation, some of your apples will rot. This is something that happens on a regular basis, so it's a normal loss. And because this happens on a regular basis, you can estimate how many apples will rot. For example, from your experience, you estimate for every 100 apples, 3 apples will rot. This is your normal loss or the estimated loss. But let's say your actual loss was 5 apples. So you estimated 3, but your actual loss is 5, which gives you an abnormal loss of 2 apples. Maybe it is so that these 2 apples didn't rot, but were stolen. So 3 apples, normal loss, and 2 apples, abnormal loss. This gives us the second differentiation. Difference may not only lie in nature of loss, but also due to the difference between estimated and actual loss. Two other points to note under abnormal loss. 1. Like we saw in normal loss, it is realized for a lower value. Mostly, that does not happen with abnormal loss. Simply for the reason, if your apple is stolen, you're not going to get any value for it. Units scrapped is nothing but normal loss plus abnormal loss. So in many questions, abnormal loss isn't given and we find it by subtracting normal loss from units scrapped. Understanding till here might just give us the answer to the question, what is abnormal effective and how it takes place. In this case again, we have estimated the loss of 3 apples. But let's say you are lucky and only 1 apple rots. Then you have an abnormal gain of 2 apples. So 3 apples normal loss and 2 apples abnormal gain or abnormal effective. Now, you might ask me why normal loss isn't 1 apple. When you are accounting, you account 3 apples as your estimated loss or normal loss. Now, when you later account 2 apples as gain, the net effect will be the loss of 1 apple. So normal loss is 1 apple. It is important to understand that normal loss is borne by the customer and abnormal loss by the business. Let us understand why so. As we said before, normal loss is a part of the business cycle and happens on a regular basis. Example, rotting of apples. On the other hand, abnormal loss is not a part of the business cycle. Now let's say your apple godown catches fire. Only your godown has caught fire, not your competitors. So you cannot increase your prices because if you do, then people will buy from your competitors. So you have to bear the cost of this loss by yourself. But apples rotting is something that happens to you and your competitors and it happens regularly. So you can pass on this expense to the customers. So we can say because normal loss is estimated and takes place regularly, business can pass on this expense to the customers. While abnormal loss is uncertain and not a part of the business cycle, it has to be borne by the business itself. Let us also see how this will impact our price and profit. Let's say total output is equal to 100 units, out of which a normal loss is 20 units, realizable at rupees 5 per unit. So normal loss realization is 20 into 5, 100. Now total cost is given as rupees 4,100, from which we subtract the normal loss realization of rupees 100 to obtain the actual cost of 4,000. Why are we subtracting the normal loss realization? Let's say we manufacture buttons. Out of 100 buttons manufactured, 20 are the wrong size. So you sell them as scrap at rupees 5 per button. Now, if you have to come up with the cost to make these buttons, you have spent 4,100 to make these 100 buttons. But you can't include the 100 rupees you get back by selling the 20 buttons because this is money you get back and is not a part of your cost. Coming back, we have a cost of 4,000 now after subtracting normal loss realization of 100. The question here is, while calculating cost per unit, do we consider 80 units or 100 units? Take a look at this table. By taking 80 units, we get the cost per unit as 50, and by taking 100 units, we get the cost per unit as 40. What does this mean? By taking 100 units, the business bears the expense of the normal loss, and by taking 80 units, the expense of normal loss is passed on to the customer. Confused? Let's make this simple. You have a profit percentage of 10% on cost. So for 80 units with a 10% profit, your selling price will be 55 rupees. So you know that the cost price is 50, which includes the cost of normal loss, on top of which you make a profit of rupees 5. On the other hand, by taking 100 units, cost price is 40 rupees. This does not include the cost of normal loss, so it is not being passed on to the customer, but something the business bears. With a 10% on cost, your selling price now is 44 rupees. You tell me if you are even making a profit at all. Finally, done with normal loss. Abnormal loss and gain. let's move on to opening work in progress and closing work in progress. PS, it gets easier from here. Let's consider we are in the buttoning process. Simply means we get a shirt with no buttons. This is the input material for this process, and the output is a shirt with 5 buttons. Now at the beginning of your work here, you have a shirt with 3 buttons. This is work you started in the previous year but are yet to complete. Simply put as opening work in progress. Similarly, at the end of the year, let's say there is a shirt for which you have attached 2 buttons out of 5. This becomes your closing work in progress. This is also the opening work in progress for the next year, during which you will attach the remaining 3 buttons. So the given picture on the right is the closing work in progress for the year 2020 and will be the opening work in progress for the year 2021. Starting to get easy? Stick with me. I will be covering small things about these different elements that will help understand the problems and accounts better. Raw material introduced. For different processes, the raw material can vary from wood, metal, wool, to soil, sugarcane, coffee beans, and anything else. Here, it is important to understand that the finished product of one process can be the raw material for another process. For example, wool can be the raw material for the process of sewing a shirt, and the output is a sewed shirt. But this output, a sewed shirt, is the input or material for the buttoning process. Finished goods. When I say finished goods, is this what comes to your mind? What if I tell you finished goods can also look like this and this? Yes, you heard me right. If you remember, we said the finished goods of one process can be the raw material for another process. This is the case here. In the first process of cutting trees, these cut logs are the finished goods. The second process is sanding and shaping the wood. Here, the wooden planks are the finished goods. Note here that finished goods of one process, of process 1, is the raw material for process 2, and finished goods of process 2 is raw material for process 3. So the finished goods of process 2, wooden planks, are the raw material for the third and final process, where the finished goods is a completely finished furniture. So we know that cut logs can also be finished goods, wooden planks can also be finished goods, and a complete sofa set can also be finished goods. And the last element in today's video, labor. Between raw material and finished goods, it's labor. They work to make the raw material into finished goods, and we account for the cost of labor incurred in each process to produce these goods.
The next video will be preparing process accounts. So we will start with the questions. As for today's video, we have covered the basic theory required for process costing. If you like this method of learning, do like this video, share it with your friends, comment what you learned, and subscribe to the channel for more such videos. Wait, don't leave yet. There's a cherry on top. You'll find a link in the description to a short and simple quiz. This quiz will help you revise and summarize everything we have learned in today's video. 3 random highest scorers will get a mention in my future videos. Thank you, and I will see you all very soon.